Welcome all. So, we are in the process of learning about the financial planning, and in the previous class I discussed with you that if you want to find out the external financial requirements for attaining a given rate of the growth, so how we can work out that, and with the help of this small given model we can easily find out the external financial requirement. And in the say with this particular model here, where we can take the assets as a proportion of sales, liabilities as the proportion of the sales, and then is the profit margin and the dividends. If these estimates are given to us, then easily we can find out the external financing requirements. And the second important thing we discussed in the previous class was the growth. Means say for the given amount of the growth, for the given rate of the growth of the firm, means what would be the external financial requirement. Because when the firm grows at a particular rate of the growth of the firm means that the growth of the sales of the firm. When the sales of the firm grow at a particular rate of the growth, so it means your financial requirements also increase, because your internal funds we have, whatever the internal funds are available from the retained earnings or from the other sources that are available with us, but we are more concerned and worried about the external sources of the finance and external financial requirement we have to work out. So, that external financial requirement to a larger extent depends upon the growth rate of the firm, or in a term I would say that the growth rate of the sales of the firm, right. So, what is the given amount of the sales in the current year, and in the next year what is expected amount of the sales. So, what is the growth of the sales, accordingly you can work out, you can plan for the external financial requirement. And see, the financial planning why we do that, if we know that what are going to be our say future needs for the funds or for the finance, if we have planned that in the beginning and we know that this much of the requirement of the funds is going to be there in future, certainly means if we know it in advance, certainly we are going to be in a very comfortable position, right. That happens in the individual life also, that happens in the say a corporate's life also, that happens everywhere, that if you are able to estimate or plan for your future, whether it is finance or whether it is any other need, we remain at a very comfortable position. And to run the business organization or business firms comfortably or in a professional manner, if we are able to plan for our finances well in advance, that gives us a means extra impetus and the means extra comfort, and the firms can perform its operations well say with the given amount of the comfort and the given amount of laxity, right. So, financial planning is very important component, and to manage your finances very well and to arrange the funds for your future requirements, if you know well in advance, then certainly we are going to be at a at an ease, and we are going to be say perform the business operations with the more say comfort, with more laxity, and we are not going to dig the well as and when there is a need for the water, right. We have already dug the well, we have already estimated our requirement, and we know that our sales are going to grow at this rate. So, our financial requirement is also going to grow at this rate. We have already known that requirement, we have already identified the sources. So, when there is a need, we can get the funds from the source and the business operations can be carried on very smoothly. So, that is the relevance of the financial planning. So, for example, in this entire say setup, when we saw this model and we discussed one thing is that what is the external financial requirement, how to work it out. So, you have to relate it with G, that is a growth, and the growth rate is important here, that with the growth rate you can find out at what rate we are going to grow. Other way around, you can look at the problem that, for example, we want to grow at a one particular rate. We know that we have the capability to manufacture the product or the series of the product or the product mix which we are already into, and we can sell that in the market. We have the demand for our product in the market, but the question mark is whether we have the required amount of the funds from the external sources or not. So, you will go in search of the external funds of the sources provided you know the amount. If you know the amount, you will go in search, or you will go for the extra production and sales, or you will be sure about the extra production and sales if you know the funds are going to be available with me. So, first you have to work out the requirement, then you have to go in search of the funds, and if the funds are available, then we can be sure about that the growth rate of the firm is assured. So, in this case we have seen, we have first of all calculated the external financial requirement, second we have seen the growth rate. So, G without G, because G is a function of all other things. External financial requirement also depends upon the growth rate, then the growth rate of the assets, growth rate of the liabilities, that is also directly linked to the external financial requirements, and this all depends upon the growth rate of the sales, because everywhere we are seeing sales is the common denominator. So, firms grow in size and in the turnover means when their sales go up. So, in this case we have found out that, for example, these rates we have found out that G for a percentage of the G, and then the external financial requirement is a proportion of this change in sales. So, we have seen that if we are growing at the rate of 5%, then the external financial requirement as a proportion of the sales or the increased sales will be 8%. If you are growing at the rate of 10%, your external financial requirement as a proportion of the increased sales would be 28%. Similarly, in this case we have seen that we are going to have that increased total sales, which is S1 in this case is the 46 million rupees, right. And now out of this 46 million rupees, 6 million we are going to manufacture as the increased sales. It means what was that? Before that 40 million was our base sales till the current period, and next year we are going to add 6 million sales more. So, delta S is the 6 million sales. So, in this case if you calculate the proportion of external financial requirement, which we have worked out here is 2.08 million. So, 2.08 million as a proportion of the 6 million works out as how much? 35%. And if you calculate this, that the say change in sales, increased amount of the sales as compared to the current sales. So, the current sales are 40 millions and the say increased sales, we are going to add up the sales by 6 million more rupees. So, that comes up as, it means we are going to increase the sales from the 40 to 46 million rupees. It means the growth rate, the G percentage here is 15%. So, you will be dividing 6 million by 40. So, you will find out at the 15% growth rate of my sales, my external financial requirement as a proportion of the increased sales is going to increase by 35%. Right. So, it means there is a clear cut relationship between the growth and the external financing requirement, but as I told you in the previous class, there are some points of caution that every time, because here we are talking about that when the sales change, assets also change, total assets also change, largely the current assets, current liabilities and provisions also change, your profit also change and your dividend ratio also change, that happens. But it may not be that it changes constantly or the change is constant. It may, there may be some ups and downs. As I told you in the previous class that if we are going to cover up the increased amount of the sales from the existing inventory which we have already with us. So, what will happen? Your current assets, rather than going up with the increased amount of the sales, will come down. It will come down, it will not go up, because you for example, what we are going to do here is we are going to sell the 100 units in the market. Out of that we are 80 units we were already selling and 20 units we are going to add up here. So, this is becoming the 100 units of the sales in the market in the current period, right. Out of this what is happening, that we have some say 50 units in the stock, which is we are keeping for our, means you can call it as the bumpy days. So, 50 units are lying with us. We are currently manufacturing the 80 units. So, 80 units we were selling currently and 80 units we are manufacturing and 20 units we are going to add up now. So, now we have two options, that if you want to increase the 20 units production from 80 to 100, if you want to take the total production and sales, you can manufacture the 100 units. 80 we are currently manufacturing and 20 units more we will manufacture if the plant capacity permits. So, we will manufacture the 100 units currently, sell them in the market and our stock will remain intact, right. We will not touch the stock. But there may be another decision taken by the firm that say for example 80 units we are currently selling, which we are manufacturing, 20 units which we are going to sell additional in the next year, we will not manufacture that, but we will draw that from this 50 units. So, your inventory will come down to how many units? 30 units, and this 20 units will be adding up here and selling in the market. So, it means the total sales will become 100 units and 30 units will be now left over there in the finished goods inventory. So, in that case what is happening? We are assuming here that your assets will increase, but in this case assets are not increasing. Assets rather than increasing, the current asset inventory rather than increasing has decreased from the 50 unit to 30 units. So, there can be any kind of the changes, or for example, it may be possible that the entire 100 units we are going to manufacture if the plant capacity permits from the current production. So, it means in that case your current assets as inventory will not change, it will remain as the 50 units, right. So, all the times blindly we will have not to follow this model that every time when there is a change in the sales from the present period to the next period, future period, always the assets increase, liabilities increase or some changes take place. We have to see that what practically is going to happen. If certainly if there is an increase in the sales, certainly you have to factor for it. If there is an increase in the short term liabilities, you have to factor for that, but if there is no change, you have not to factor for that. So, this I discussed with you in the previous class also, this I wanted to thought of reminding you in the current class also. So, next thing, now the two more important things which we are going to learn here are the important other corollaries of the financial planning, and these corollaries of the financial planning are, one is the internal growth rate and second one is the sustainable growth rate. Because why the financial planning is important? Currently if we want to keep on performing at the present rate, then there is no issue at all. We have the sufficient amount of the funds maybe from the internal and external sources, and if we want to generate the funds from external sources, we know it that what is our current requirement as per the current volume of the production and sales. So, we are at a comfortable position. Financial planning is always required when the firm wants to grow in the market, and since firm is a dynamic organization, it is not a static organization, growth is always expected to be there with every business organization. At whatever the level they are performing in the current year, next year they expect to increase their level of production, their level of sales, their level of operations. So, growth is means you can call it as is directly related to the performance of the firm. Without growth there is no business, and a business which is a static business, you can't call it as the business which is professionally managed. So, growth is directly related, it is linked to the firm performance. So, you always have to be careful about that. So, when there is a growth in the firm, maybe the overall growth, and the overall growth takes place with the growth in the sales. When the sales of any firm grow, then in that case how we have to fund that growth, how we have to fund that growth. So, here we are going to talk about that. One important thing is the internal growth rate and second one is the sustainable growth rate. So, what is internal growth rate? Let us see it here. The internal growth rate is the maximum growth rate that can be achieved with no external financing whatsoever. No external financing, that is why it is written here as internal growth rate. We do not want to depend upon the external borrowings, we do not want to grow in the market by external borrowings or external source of financing. We do not want to risk the firm, because here the point of caution is that when you raise extra funds from the market by borrowing, especially in the form of the debt, it creates so many problems for the firm. It is always good that the borrowing is always good if you are assured about your production and sales in the market and the growth rate of the firm. But because of certain ups and downs in the market, as in these days, for example, the recession is going on in the market and firms are not able to say sell off in the market whatever they are producing. Many a times their production they have to stop. For example, you talk about the automobiles companies, almost every company is stopping the production for 1 day, 2 day, 1 week or 15 days or something like that. They are retrenching their contractual employees and the demand is not there in the market. So, because recessionary phase is there in the market is hit badly by the recessionary phase. So, the performance is not up to the mark. So, in this situation, if you have raised the funds from the external sources, especially by way of borrowing. So, borrowing sources they do not wait for that, you are not selling in the market as per the expected amount. So, you are not able to return their funds back, you have to return their funds back. So, if there is a sustainable growth and sustainable production and sales in the market, then fine, you can service the external debt and you can pay the principal amount also as and when it is due. But sometime if it is hit by the recessionary problems in the market, then external financing becomes a problem. In the capital structure also I told you in some previous class that capital structure basically, what is the capital structure? It is a mix of the debt and equity, it is a mix of the internal and external sources. So, if you are funding the growth of any organization from internal sources, though it is expensive, it is costly, debt is cheaper because it is tax deductible, but debt comes with so many limitations that debt is always cheaper, supportive and better if the firm is maintaining the sustainable performance and the growth rate. But if it is hit by the negative economic environment or because of the negative conditions in the market, then it is not good for the firms to depend more and more upon the external borrowings. The well managed organization like Reliance Industries or the Grasim Industries or maybe well functioning other business houses, if you look at their balance sheets, you will find that their external borrowings are much less as compared to their internal reinvestment of the funds whatever they are generating internally. Now, you see in case of the Vijay Mallya's companies, what happened? He resorted to the external borrowing so much, 9,000 crores, and internal whatever the funds were being generated, they were misappropriated, not properly reinvested back into the business. So, finally, when they resorted to the external borrowing so much that one day a time came that they were not able to justify that what is their borrowing and how properly they are making use of it. Finally, the business collapsed. All Kingfisher Group companies, they collapsed, and finally the chief promoter of the company is now in the difficult state of affairs. Similarly, you talk about the Nirav Modi, because why they had to meet this kind of the fate? Because their borrowing was so much from the market, because they thought easy funds are available from the market, so borrow it and we will think at the time of return of the funds whether we are able to return it or not, and finally they have to pass through this kind of the phase that they have to leave the country. So, be careful always as a good financial manager, you have to be very careful that external borrowing has not to be resorted, or if it is to be resorted, at a minimum possible amount. And if you are borrowing a 1 rupee from the market, at least invest 1 rupee from your own pocket also or from the internal sources also. So, if the internal generation of the funds is there and reinvestment of the internal funds is there, then certainly you can borrow from the market also, but always keep your borrowing power intact, so that tomorrow if the internal funds are not available and somehow we have to borrow funds from the market, then yes, you can make use of that always unused borrowing capacity, right. So, we are talking about here the one important corollary of the financial planning, internal growth rate. When you talk about the internal growth rate is the maximum growth rate that can be achieved with the no external financing whatsoever. It is a growth rate that can be sustained with the retained earnings, which represents internal financing, So, it means you can find out the internal growth rate you can work out is, that is the return on assets into flow back ratio divided by the 1 minus return on asset into the flow back ratio. So, internal growth rate can be worked out. That is the return on assets into flow back ratio and 1 minus return on assets into flow back ratio. With the help of this model, internal growth rate can be worked out. Second, one more corollary is the sustainable growth rate. Sustainable growth rate is, means what is written here, let us see it. Sustainable growth rate is the maximum growth rate that a firm can achieve without resorting to the external equity finance. It means in the previous case what we have seen, that it is a growth rate that can be sustained with retained earnings which represent the internal financing. It means internal growth rate is the maximum growth rate that can be achieved with no external financing whatsoever. In this case, we are talking about both debt and equity, that we are talking about the largely the focus in this internal growth rate is upon the external fund, and that the emphasis here is on the debt, right. That without borrowing anything from the market in the form of the debt, we want to grow, and what growth rate we can achieve, that can be worked out with the help of this model, right. In this case, what we are talking about here is that sustainable growth rate means that whatever the amount of the funds is available with us, we want to grow with that, with that rate of growth how much we can grow. Here we are talking about of the zero borrowing. Zero borrowing, that no borrowing in the form of the equity, we will not have any external financing. So, whatever the funds we have internally available from within the internal operations, that only means we want to make use of, and with the help of that, it means if the situation arises tomorrow that, for example, if the firm's equity is not very means preferred stock in the market. So, if they want to raise additional equity or the funds through additional equity by coming out with an FPO followed on public offer in the market. So, it may be possible that it will not be subscribed at all, because existing stock of this company is not doing well in the market, in the stock market. So, people might have the say apprehension in the mind that no, this company is not good and we will not buy the stock of this company, right. So, external equity is not available. At the same time, because the reputation is not very good, or maybe because of any temporary setback, the borrowing is also not available. So, it means in that case, whatever the funds available with this company are, they have to run the show for the time being with that given amount of the funds. It means they have to sustain in the market at the means whatever the amount of the funds are already available with them from both debt and equity. So, it means that rate is called as a sustainable growth rate, that at what rate you can sustain in the market, or what is your sustainable growth rate without resorting to any kind of the external financing, debt or equity. How can you stay in the market, or how can you perform in the market. So, this all is about the financial planning we wanted to discuss here. And when you talk about the financial planning as a whole, the concept of the financial planning as a whole, you can understand that it is very, very important to always look forward into the future. It is always important to look forward into the future. So, if you wanted to be sure about that, yes, what is our financial requirement for the future period, if it is estimated beforehand and if the funds are already arranged. So, as and when we need those funds, they are already available with us, we can arrange the funds and we can run the show in the market. So, financial planning has a very, very important role to play, and for every department, every say unit and subunit, budgeting is the one exercise which is the planning tool. So, we prepare the budgets for all the units and subunits and we translate that into the financial terms, and then we sum total it. So, we call it that this is the total financial requirement of the firm, and then at the end of the say this entire process, we prepare the projected financial statement, projected your income statement, projected your balance sheet and the projected cash flow statement, so that we are going to create a balance sheet, we are going to create a profit and loss account, which actually will be there in the next year, right. So, if that projected balance sheet is already with us, we are a very comfortable position. Number one, it acts as a roadmap, the guiding force, and second thing, it puts the pressure in the minds of the people working in the different units and subunits, that what their performance is expected up to, right. So, if they know well in advance that this is the target we have to achieve. So, the production department is very careful how much production is expected, purchase department is very careful how much purchases are expected, marketing department is very careful, R&D department, your sales and distribution department, and finance department also is very clear that this is the requirement of the other department. So, this much of the funds we have to arrange, we have already arranged the funds. So, the funds can be provided, so that your budgeted profit, which is we are calling it as a projected profit, can become the real profit. The budgeted financial position, which we are calling it as a financial position, becomes the real financial position, and similarly the budgeted you call it as the your cash flow statement becomes the real cash flow statement. So, this is the role of the financial planning, which is very, very important in any kind of the financial management functions, and as a student of finance, you must be very clear about what is financial planning, what is the role of it, and how the financial planning is done in any organization, right. Now, I will discuss with you small two problems that means where we will apply the concept of say calculating the growth rate without resorting to the external sources of the funds. Any kind of the external sources of the funds means internal growth rate, how we can achieve the internal growth rate, and for that purpose we have some say information here, and with the help of this information we will calculate the internal growth rate without resorting to the external financial requirement, because here we have calculated the external financial requirement EFR. So, if there is no external funds are available, then from the given internal funds, how we can grow in the market and what can be the expected growth rate, how can you calculate that, right. So, for example, this is a company, call it as XYZ Limited, and about this company the information available with us is asset to sales, means asset to sales are expected to be in the ratio of 0.80, and then as the liabilities to sales L by S are expected to be say 0.50 in the ratio of 0.50. Profit margin, if you look at here the profit margin, that is expected to be say 5%, and dividend payout ratio, if we talk about the dividend payout ratio, that is the 0.6, and previous year's sales, though we do not require it, but previous year sales are given to us as rupees say 1200, for example, we assume it as rupees 1200. So, question is what is the maximum sales growth rate, maximum sales growth rate, maximum sales growth rate that can be what is the maximum sales growth rate that can be achieved, without raising external funds, right. This is our question, without raising the external funds. So, this is our question here, maximum sales growth rate that can be achieved, means we have to find out, that can be achieved without raising the external funds, right. So, now if you look at this part, we have to find out this external growth rate, and for this external growth rate we have to now go ahead with this. Is the simple formula given to us is that if you apply this formula, the formula is EFR, external financing requirement delta sales, and is equal to what is this, A by S minus L by S bracket closed minus small m into 1 plus G, that is the growth rate, into 1 minus D, right, and divided by G here. This is our model, this is the formula. So, what we are given here is we are given the A by S, and A by S is how much, 0.80. This amount is A by S is 0.80, that is the asset to sales is 0.80. We are given the L also, or say L by S. What is L by S? L by S is also given to us is 0.50, and then we are given the M, small m, which is given to us is how much, that is 0.05, and then we are given the D, D's value is, that is the dividend value, the dividend ratio is also given to us, and that is 0.6, right. And what is the question, maximum sales growth rate that can be achieved without raising external funds. So, EFR is equal to 0. So, it means we are given this all information. So, this side becomes 0 if you apply this into this model. So, what is going to happen here, this side will become 0, and this is going to be how much, if you take it as, so this will become something like 0.8, then minus 0.5, and then it is minus, if you take this here, this becomes as how much, 0.05. This is the profit part M, and then what is the growth rate, that is known to us, that is not known to us, we want to find out this growth rate. So, we are going to close it, and here we are going to find out this ratio is 1 minus D, D is 0.6. So, this 1 minus D becomes is the 0.4. So, now, and what is the growth rate here, that G is also not known to us, we want to calculate this G. Now, if you solve this particular equation, so I think the value we have put here 0.8 minus 0.5 into 0.05 and that is 1 plus g, which we want to find out, into 0.4 and divided by z. So, finally, this is equal to 0, right. So, in this case, if you want to find out this growth rate, if you solve this particular equation, so what you will be able to find out here is that if you solve this equation, your g will come out as, finally the g will be 7.14%. G will be the 7.14%. So, what is here we wanted to find out that this is a company XYZ Limited and their all information is given to us. Asset to sales will be 0.80, liability to sales will be 0.50 and the profit margin will be 5% and dividend payout ratio is 0.6 and the say you can call it as the existing sales, you call it as, that is the pre-period sale or the present sales, you call it as 1200s. So, it means the sales will be increasing, the growth rate of the sales will be 1200 into 7.14% if you do not resort to any kind of the external financing. So, in this case we have not taken the external finance as a say as a proportion of the increased sales. So, it means we wanted to find out that from this given information, if we want to find out the growth rate. So, growth rate we have worked out is that without resorting to the external sources of financing, if you have the present rate of the sales or the level of the sales is worth rupees 1200. So, it means without having any extra funds invested from outside, your growth rate for the coming period will be 7.14%, means now the next year the sales will be 1200 plus the 7.14% of the 1200. So, that will be the total amount of the sales. So, it will become 1 plus R, R is the growth rate, or 1 plus G you can say. So, G will be the growth rate and growth rate is the 7.1%. So, without say resorting to external sources of financing, you can calculate the growth rate and this way the growth rate can be worked out with the help of this model. One more problem relating to that say sort of that, for example, for the given amount of the sales, if we are going to predict that we want to achieve the certain amount of sales that currently we are selling, for example, for 400 million rupees and next period we want to sell for the 500 million rupees. So, if we want to increase the sales from the 400 to 500, so what will be the external financing requirement, that also can be worked out. So, that one more problem I will do in the next class and then we will stop the discussion on the financial planning. You can refer to the books of for the detailed discussion, you can refer to the books on the financial management, and one book I am again time and again referring to is the Financial Management by Prasanna Chandra. If you refer to that book, so detailed discussion on the financial planning you can have in that book. So, one more problem we will discuss in the next class and then we will close the discussion on the financial planning. So, for this class I will stop it here. So, thank you very much.